Welcome to today's deep dive into everything you need to know about how to read candlestick charts. In today's episode, I'm going to reveal the most profitable candlestick chart patterns that I utilize in my own trading. I'm going to teach you how to find these patterns in real time, and you can begin implementing them in your trading starting today. Here's the amazing thing about learning how to read candlestick charts. Candlestick charts and technical analysis are the universal language of the financial markets, which means it doesn't matter if you're trading stocks like I am, or if you're trading cryptocurrency, Forex, or futures. Once you learn these universal chart patterns, you can apply them to any financial instrument. Now, during today's episode, I'm going to walk you through how to spot these candlestick chart patterns in real time, and I'm going to show you precisely where I buy and where I sell. Now, for those of you guys that want to continue learning, at the end of today's episode, I'm going to provide you with some recommended reading. Now, let's go ahead and dive right in. I'm going to begin this episode with a pop quiz. All right, so let's level set, make sure we're all on the same page. Right now, we're looking at a chart of a stock that is squeezed up very quickly. It moved up, as you can see, on these nice green candles, and then it topped out right here. We had one red candle, and now we have a small candle right here. So here's my question to you. Is this a place where I should press the buy button? Now, I hope that you would say yes. And if you did, you would be absolutely right. However, a lot of beginner traders screw this up. And I know it's crazy, but here's the thing. Most beginner traders lose money. And you know what? Most beginner traders don't know how to perform technical analysis the right way. And when it comes to reading candlestick charts, what a lot of beginner traders do is they learn the basic candlestick shapes, but they apply them to the wrong financial instruments. And that right there can make all the difference. So today, you're not only going to learn how to read candlestick charts, I'm also going to teach you how to find the right instruments to apply them to, because that's where success really comes in. So if we think of learning how to read candlestick charts as being similar to learning another language, I would say that the candlesticks are sort of like the letters of the alphabet, and they form together to create words. And the words are what I see plain as day on the chart saying buy, sell, or maybe hold. Those are indicators and signals on the chart that your eye may not yet be trained to see, but that's going to change today. Now, before I can teach you my favorite multi-candlestick chart patterns, the ones that are the most profitable in my own trading, I want to make sure we're all on the same page with understanding the anatomy of how the building blocks are formed, how each of these individual candlestick shapes are created, and what the shape is telling us. Because something that you're going to learn is that a subtle change in the shape can communicate a significant change in market sentiment. This little line that I just added there changes this pattern entirely. So you've got to be able to really understand how these candles are created. Now, some of you may have watched one of my full-length trainings on decoding the anatomy of how to read individual candlestick shapes, each of these building blocks that we use to create and visualize and understand our multi-candlestick patterns. So for those that have already watched one of those episodes, this is going to be a crash course. For those that haven't, that's okay. I'm going to give you what you need to know for today's episode, and I'll put a link at the end of this episode where you can watch one of those deep dives if you want to continue learning and go deeper, and you're welcome to do that. So let's take a step back. Let's flip over to the other side here of the whiteboard, and I'm going to just draw a simple candlestick. So a candlestick actually has 4 pieces of information, and candlesticks, just a little piece of history, have been around for hundreds of years. They were created in Japan to track the price of rice futures. But today, they are the most popular type of chart pattern or chart style that is used in the financial markets. In contrast to candlestick charts, you have bar charts, you have line charts, histogram charts, and then you also have footprint charts. Now, these are used by some traders, but to a lesser extent, it's sort of subsets of the market and are not even close to the most popular. Candlestick charts certainly are. So what we like about a candlestick chart and an individual candlestick is that each candlestick is created using 4 pieces of information. And this is all essentially creating a historical record of the variation in price that occurred during a set period of time. So the time on this candle, well, it could be any number of times. Most day traders are using 1-minute candles, where every individual candle is 1 minute of time. But swing traders are often using 5-minute candles. We'll just change that. They're using 5-minute candles where each candle represents 5 minutes of time. Some use 15-minute candles. Some use hourly candles, so a 1 hour or a 60-minute. Others use daily charts where each individual candle represents one full day of price action. So regardless of what time frame you use, and for the sake of argument, we'll just stay on a 1-minute chart, the patterns that you're going to learn are the same and can be applied to any time frame, can be used certainly in any financial market, and both for long-term investing and also as fast as micro scalping and high-speed day trading. So when you look at a chart, you select the time frame for that chart, and then all the candles on that chart will be based on that time frame. So they'll all be 1-minute candles. So in this 60 seconds of time, this 1-minute period, this tells us the price that the stock traded at. So this was the opening price at the bottom. That's the open. This was the lowest price of this 60-minute window, the 60-minute time frame. This right here was the highest price, and this right here was the closing price. So those 4 pieces of information come together to create this candlestick shape. Now, let me just sort of do a hypothetical of how the price actually changed during each of these 60 seconds. So we opened, we might have moved up, and then we certainly went down because we know we had to create the low point. And then we came all the way back up to the high point, and then we came down. Maybe we came down a lot, and then we ultimately closed right here. Now, in reality, we don't know exactly what happened except for these 4 pieces of information. Now, if we actually broke this all the way down to something like a 10-second chart, then there would be actually 6 candles inside this 1-minute candle that would give us more detail, right? So you can always zoom further in all the way down to the individual second, which would be the highest speed chart. But most people don't use that. So what we know is that during this 60-second window, this was ultimately something like this occurred. So this is a green candle, opens at the bottom and closes at the top. So it's green, so we can understand that. Now a red candle, essentially the same thing happens, except that we open at the top. We open up here, and then there's the high, and then this is the body of the candle, which connects the open and the close. That's the close, and then this is the low. So we've got the open, the close, the high, and the low. So you have the same thing. The only difference is that we opened at the top. We then maybe dipped down, we popped up, then we sold all the way down in one candle, then we came back up, and then we settled out here. And so what was ultimately created were the 4 pieces of data: open, high, low, and the close. Just to circle them. Those are just a circle, just to sort of highlight. So that's essentially the anatomy of an individual candlestick shape. Now, something that I pay close attention to while I'm trading is the time. And the reason I pay close attention to the time is, and I'll pull up my charts here just so you can see, for example, we'll just look, well, let's see, what's the current time? So right now, you could see the current time. We've got approximately 30 seconds left on this candle. That's just by looking at the current time. So I often will do that, and then what I know is that this current candle is still forming. So we don't know what its final shape will be. We already know what the open price is, so that point is remaining fixed. The candle is becoming more green, but I watch this and I see now we've got about 12 seconds left, 10 seconds left. So as we come to the end of that period of time for this candle, the shape of the candle starts to become more confirmed. Like this is gonna be, looks like a small green candle, and now that candle has closed. And that candle, now that it's closed, is a permanent part of the history of this stock. This is now, that candle's gonna be there forever. So what candlestick charts do is they record all the historical price action, but they can't exactly tell us what's coming next, except that we recognize certain patterns. And we recognize that certain candlestick shapes, based on its shape, is sending a message. So that message communicates market sentiment, strength or weakness, and we then use that to make a prediction, hopefully accurate, of what's going to happen next. The best traders are able to see into the future. So what happens is in real time, when this stock is moving up, you've got your first 2, 3 green candles, you start to think, okay, I'm waiting for an entry point. It starts to pulls back a little more, and now you're starting to think, okay, I know that I'm gonna wanna be buying this. So what you're visualizing is what's gonna happen next, that maybe it's gonna go back up like that. And so you're using all of these candlestick shapes and their subtle meanings in combination with sort of the bigger context of what's happening in the market. What's the story with this stock? And so I use the chart to give me that context. It tells me what's happened, and then based on what has happened, I make the prediction of what's going to happen. So this is the anatomy of basically an individual candle. Now what I want to do is create sort of a hierarchy here of the candles that are the most bullish and strong, and then the candles that are the weakest. So these are going to be strong over here, which we would also call bullish. And then these candles over here are going to be weak, and we would say bearish. All right. So now it's important to understand context here, but let's get into it. So naturally, a bullish candle would be a candle like this, right? This candle has the bottom. It basically opened. It never went down. It went straight up and it closed at the top. That is a very bullish candle. Okay, so what's less bullish? Just basically the same, but slightly smaller. And what's even less bullish? Even smaller? What about something like this? A candle like that, where it opens and closes at the same price, or even a candle like this that has a small body, this starts to show a little bit more indecision. In fact, this candle right here is often called a candle of indecision, because what happens is the price opens, closes at the same exact price, but it pops up, drops down, but then still closes right here. This is a candle that's called a doji. It's a doji candle. A doji opens and closes at more or less the same price. It's a candle of indecision. Now, there are also a couple other candlestick shapes that you're going to see here. There's this candle. There's this candle here. And then we're going to get into, over on this side here, you could have the same candlestick shapes that are red right here. And then the little, we call that a spinning top, where it's a small body, but it has an upper and a lower candle wick. You've got your doji, and then you've got your small body candles, and then you've got your slightly larger body candles, and then you've got your very large long body candles. So that's kind of the spectrum there of strongest to weakest. And some of these you may be able to interchange a little bit, but more or less that's kind of how we break it down. So now with that in place, if we look at this pattern here, we've got a long body green candle, very bullish. Slightly smaller, slightly smaller. So let me help you make a little bit of a prediction. So let's say we had a long body candle like this, a smaller candle, a smaller candle, a smaller candle, and a smaller candle. What is this telling you? So the candlestick shapes here are now communicating a message, of course, in context. Now, each of these candlestick shapes simply by themselves may not really send the same message, but in this context, they're showing that the trend is weakening. So what might we be concerned about? Perhaps a doji, the candle of indecision, and then perhaps a reversal, a couple of red candles coming back in. Well, let's do it a different way. What if you saw something more like this, where the candles are getting bigger, right? They're getting increasingly bigger. This is what happened during the GameStop short squeeze. Well, you don't know where it's going to stop, but clearly there's a lot of momentum behind this move. So this communicates a tremendous amount of strength, increasing momentum, building momentum. Now let me show you these doji candlesticks in a little bit more detail. So we've got, let's just do a couple candles up here. So we've got a couple candles up, and then up at the very top, we have a doji, the doji candle. So a doji candle like that is considered a reversal indicator. That's basically the market throwing out that caution flag, saying, hey, we had really strong momentum, and now we're having a little bit of tug of war. There's a little bit of a battle between buyers and sellers. Maybe buyers are not as confident buying at these levels. Maybe sellers are a little bit more bold. And so all of a sudden, this is sending out a caution flag. If you see it as that, you'll know that if you're in from down here, you should probably get out. Because what would confirm this would be the next candle going red, and why wait for it to go red and then end up getting out way down here? You're gonna wanna get out sooner. So a doji candlestick is an early warning sign that a trend may be about to reverse. But you know what's interesting about the doji? That's a standard doji, but there's another one that's called a gravestone doji, and it looks like that. A gravestone doji opens and closes at the same price, but doesn't have a bottoming tail. It only has the topping tail. We call it a topping tail, sometimes we call it a candle wick. And the fact that it doesn't have the bottoming tail, it only has a topping tail, what does that tell us about the price action if we sort of zoomed into this candle? So the price opened, it squeezed up, it came all the way back down and closed right at the bottom. What kind of sentiment is that? It's negative, it's bearish. It's telling us the price is being suppressed, it's being pushed back down. In fact, it almost shows that the reversal has already begun. And so what's very likely to follow this is that it opens and goes red, right? Because remember that a candle closes and then the next candle opens at more or less the same price. So it now opens and goes red. So this candle right here is called a gravestone doji. It has an ominous name indicating the price is probably going to come back down. Now, there's another version that I'll show you here where the stock has been selling off, and then down here, you get, and it could be either red or green. It doesn't really matter. Ultimately, a doji usually opens and closes at the same price, so it's actually a black candle. So this is actually called a dragonfly doji. A dragonfly doji. What do dragonflies do? Well, they take flight, of course. They open, they squeeze up. Dragonflies are beautiful. So now you've got this nice, majestic sort of symbolism here of the dragonfly at the bottom of the pullback. This is a reversal indicator because it's a doji, but the dragonfly indicates what happened inside this candle. We zoom into that, and we know that the price opened, it sold off, it came back up, and then it closed. The reversal has already begun. So that is bullish. Now, let me paint this picture a little bit differently using two new candlestick shapes that you perhaps haven't heard of yet. Down here, I'm going to fill this in. I'm actually going to make it green. It's a little bit better if it's a green candle, but it can be red. So we're going to open like this, and we're going to have this bottom right here. Okay. This is called a hammer. Why is it called a hammer? Well, it kind of looks like a mallet. See, you've got the little body of the mallet and the little handle. And the saying is that this is hammering out a base. So what happened inside that candle? Inside that candle, if we zoomed in on it, the price opened, it sold off, it reversed back up, and maybe, if it's a green candle, even closed green. So you have that hammer. Now, even if it closed red, it still indicates that the buyers brought it back up. So in this case here, this is a bullish candle. It's called a hammer. Now let's go back over here. Let's look at this for a moment, and let's get that red. We're going to change this to red. So just change this to red. So this is red, and let's just say it looks like this. That's called a shooting star candle. So a shooting star candle opens, squeezes, gets pushed back down, and ends up closing red, which means the reversal has already begun. Now, it could be green as well, just as the hammer could be green. But the fact that it's reversed this much is obviously indicating the weakness is coming in. So what you're going to notice here is that when you have a candle that has a large topping tail, it's generally considered bearish. And the reason is because while the price surged up, the sellers pushed it back down. And down here at the bottom, when you have bottoming tails, they're usually bullish because while the price sold off, it got rallied and pushed back up. So now you've learned a couple of new candlestick shapes. This was the hammer. This was the shooting star. We've got the hammer, the shooting star. And again, they can be either red or green. We've got our doji candles right here. And we can further add let's go ahead and add a dragonfly doji right next to it. I'll just put it right here. So, with the bottom. So that's the dragonfly doji. And we're going to go ahead and add, I'll just put it right here just to add it. We're going to add the gravestone doji, right? So the standard doji, and then this one here is the gravestone doji. So we've got our dragonfly. And then we've got our small body candles. and we've got our long body candles. And I guess the other one that I had mentioned is the spinning top, which can be either green or red. A spinning top has a small body and then an upper candle wick and a lower candle wick. And again, it communicates indecision. Now, let me show you an example on a chart here. Let's see. I mean, even right in here. So in this area right here, you have a stock more or less trending down and kind of going sideways. The last significant candle was this longer body red candle. And now these little candles bouncing back up, you could say, oh, this is sort of a shooting star right here. But the reality is, in this context, the stock is already weakish, mostly going sideways. So it's hard to draw really strong conclusions about these individual patterns when the stock is already in a period of being indecisive. In other words, these patterns are the most significant when they occur near the top of a stock and it doesn't have to be a stock, it could be really any financial instrument, but when it occurs at the top of a really strong trend. Because what we're trying to identify are these moments where trend is shifting. So you have something that's been moving up, that's great, then it reverses and comes back down. We need to make sure we understand that before it happens so we can get out. When it comes back down, if it holds up and it reverses back up the next direction, each time it changes directions, that's where we want to get dialed in. So ultimately, we want to be, let's say this had a wave down back here, just for instance, we want to be buying and selling and buying and selling, right? So what we want to get really good at is understanding when the momentum is shifting from selling to buying and then shifting back from buying back to selling. These are the shifts that are really important for us to be able to recognize in real time. And so these patterns that I'm about to break down for you, the three that are the most profitable in my own trading, they really get focused on what I would call apex points, which is this is the moment where the trend is shifting and my best entry is going to be buying as close to the low as possible because that's when I'm taking the least amount of risk and I'm presented with the largest amount of possible reward because that's what it's all about, risk and reward. Okay, so now you understand the anatomy of candlestick charts, the building blocks of the individual candlestick shapes, and to some degree, the sentiment that these candlestick shapes communicate, and you understand the different charting timeframes. So now let's go ahead and I'm going to start walking you through my first candlestick chart pattern that I want you to learn. This is called the candle over candle pattern. So the way it's created is through two candles. You have the first candle, which as you can see here is just a solid long body green candle. The second candle breaks and makes a new high, which makes it a candle over candle pattern. We call it candle over candle because what's happening here is this candle, the second one, is actually breaking and making a new high. So this was the high of this candle. Let's just say, for instance, that was $3. And then when this candle breaks 3, the second it breaks 3 and goes to 301, it's made a new high and it's broken over the previous candle. So whenever we're looking at charts and we're seeing candles making new highs, those are always going to be the result of candle over candle over candle over candle formation. So this is a bullish pattern where we continue to see candles making new highs. Now, one of the reasons that this is, to me, an important pattern for you to understand is because when we're talking about reversals, a candle over candle pattern. So let's just say, for instance, we had a stock that was selling off. All right, so we had a red candle, red candle, red candle, red candle, and then down here at the bottom. So each one of these candles were making a new low. So this moment right here is a candle over candle pattern. So that's the same pattern. It's candle over candle. So you have your first candle and then the second one made a new high. And in this context, this is something we pay a lot of attention to because what we're seeing here is reversal. The hammer at the bottom was the reversal indicator, and then the candle making the new high is the confirmation. And once you have this confirmation, in fact, you get the confirmation the second this candle breaks over the high of that candle, the second it happens, you've got confirmation. And as it goes higher, now you have traders who are buying and they're looking for a reversal of trend and a move back up. So that candle over candle pattern, it doesn't have to be just two green candles. It can be the first one's red and then the next one's green. This is, for me, a lot of times the apex point, which is the moment that I'm buying to the penny. That's the place right there when that first candle makes a new high that I'm a buyer. And that is a candle over candle pattern. So the reason that I want you to learn this pattern is because this is one of the building blocks for the larger patterns like the bull flag and the ABCD pattern. They have candle over candle as critical components that you need to be watching because those are going to be your indicators to go ahead and press that buy button. Okay, so now let's look at our second candlestick shape, which of course is the bull flag. So the bull flag is formed initially by a long body green candle. Now a bull flag can be formed by as little as one single green candle, although typically it's formed by a couple of candles. So let me give you a little scenario. Let's just say, for instance, that all of a sudden it's 10 a.m. Let's just say, for instance, 10 a.m. Eastern Standard Time, and a company has put out a breaking news headline. So they've got breaking news that came out, and instantly, in an instant, the stock squeezes up, 10% or whatever the case is. So immediately you get that large green candle. And in fact, it happens so quickly that a lot of traders barely even have a chance to pull it up before the candle has already formed. So rather than chase that candle, which would be a mistake, we have to wait for a pullback. Because one of the things that's really important to understand about trading is, of course, trading is risky. And so we mitigate our risk in a couple of different ways. Number one, by choosing the strongest places to buy, where we're buying very close to support. And so if we jump back onto the whiteboard here, what we'd be waiting for is a red candle right here to pull back. And then in fact, if the next candle bursts higher like that, you already have a candle over candle formation, and that's a potential place to buy. So this would be the shortest bull flag possible. 3 candles, that it could not be shorter than that. It just couldn't be. However, this is not a very well-formed bull flag. A more proper bull flag is going to look a little bit more like this animation here. So we've got the first green candle and the second one that pushes a little bit higher. And then we get a red candle. Now remember, when it comes to candlestick charts, the previous close, generally the next open, is around the same price. So you close, and then the next one opens here. And then this closes, and then the red candle is going to open at more or less the same price. Maybe a little higher, a little lower, but more or less the same price. And then it goes a little bit lower. Oh, so here, this is our moment. Okay, so we had our first red candle, we had our second red candle. So what we're looking for is pattern number 1. We're looking for that candle over candle formation, and right there, we got it. That was our first candle to make a new high right in that moment. So our low of the whole pullback was the bottom of this red candle. So the bottom of that red candle becomes our level of support. That becomes essentially our max loss. So we know that that was the low of this little trend. And we're buying for the trend reversal and the move back to a new high of day. So if our entry is right here, right at the top of that candle, it's not the top of the body, it's the actual top of the candle wick. That's the moment we're pressing the buy button. So we are buying right about here, and our max loss is right here. So let's just say that's 10 cents per share. So if that right there is 10 cents per share, then the amount of money you're risking will be based on the number of shares you bought. So if you bought 1,000 shares, you'd be risking $100. So 10 cents a share of risk. And the way I think about trading is that I never want to risk more than what I can stand to gain. So at a minimum, if I'm going to risk $100, I need the potential to make 100. But I'd prefer the potential to make 200. That way I have a 2-to-1 profit to loss ratio. Aim high. Even if you come in a little low, it's okay, but it's better to aim high. So that means if I look at this pattern and the high of day right here is, if it's too close, then I wouldn't take the trade because my profit target is high of day right here. So in this case, this is a 10-cent stop. So that's 10 cents of profit. That's like 20 cents of profit. So in this case, we've got about 25 cents of profit potential, which makes the trade worth taking. So this is a trade that I would be completely comfortable taking. And there we go. We get that first candle making a new high. And then the next candle is continuation. More traders come in here as this pushes towards a new high of day. And that's exactly what we want to see. So that right there is pretty much a picture perfect bull flag pattern. Now, they don't always come out picture perfect. Sometimes you'll have a pattern kind of like this where you've got one green candle, one red candle, and then the next one's green. And it goes very quickly. This will tend to happen if a stock has breaking news and the news is really good, because traders aren't going to wait long they're not going to wait long to buy. They see a little dip and immediately they're starting to buy because they're afraid it's going to go without them and they don't want to miss it. So maybe they only take a small position, but they just start buying sooner. So when you've got really good news, it's not uncommon that the patterns won't take as long to form. They'll just start to resolve faster, which isn't necessarily a bad thing. It's just something to be aware of. So let me show you an example of a bull flag. So here we have this example of a chart where the price has kind of been going sideways here. So this is not an example where the stock suddenly had breaking news. This is more an example of something that's been holding up pretty well and then suddenly starts to pull away. So all of a sudden some volume comes into it and it goes from $4.80 all the way up to $5.80. Now, could you have bought right down here? You could have, and that is a small bull flag. You've got 3 green candles, a small red candle, and then it pushes higher, but it may not have been as obvious. Once a stock starts to really move quickly, more traders are paying attention to it, and that's when these patterns really work out well. So here, all of a sudden you get 1, 2, 3 green candles in a row, but the top one is a smaller green candle. So you get that smaller green candle, and then you get the red candle right there, and then boom, you get that little bottoming tail right there, and then all of a sudden we get that squeeze back up. So the way I trade this is I'm looking for that first candle to make a new high. So what's that candlestick shape right there? That's our dragonfly doji. It's almost a hammer, but it happens to be just the body, just the little candle sort of open and closes the same price. So it really takes more the form of that dragonfly doji. So in this context, this is bullish. This tells us that the reversal is already beginning. And then as we see this candle make a new high, that's our confirmation. So the moment that I buy is right here. The second this green candle here broke the high of this little dragonfly doji, I was a buyer. So let's say it looks like that was at approximately $5.50. And it looks like my max loss would have been around $5.38. So about 12 cents of risk on this trade, 12 cents of risk. So as long as I have the potential to make 24, 25 cents, I'm going to be thrilled to take this trade. And this peak right here was just under 580, which gives me just about exactly 25 cents of profit potential. Now, in this case, this resolved really well and it ended up going all the way up to 6 to 640. And then you can see how it pulls back here because you have the topping tail. So I likely would have taken some profit off the table once it started to pull back just a little bit there. The way I would have been able to visualize it pulling back is by actually looking at the flow of every individual order going through the market, which I can see on the time and sales, and I can see on my market depth window, which are the detailed market data subscriptions that you get inside your trading software. And you would get this whether you're trading crypto, futures, Forex, or stock. You could see that market data. So when I would start to actually see that selling, I might take some profit. But I don't have to sell my entire position until I get stopped out. So getting stopped out means you're actually hitting the price either where you initially got in or where you've said, if it goes below this price, I'm going to get out. So for instance, once it broke above $6, that's a whole dollar. It's a nice psychological level, the whole dollar. So once it's above it, as long as it can hold above 6, I'd be pretty happy to keep holding. So I might have moved my stop from my initial average of 550 all the way up to maybe 590. So new stop is 590. And as long as it holds 590, I'm going to hold. And boom, all of a sudden there, we get that move up to 680, a little pullback and a pop all the way up to 7 and a tap of 720. And then look at this candle right here at the top. That is a large doji. And that's communicating indecision. So all of a sudden here at the top, we got this big candle of indecision. And when that candle closes, that's my point to get out. and I don't even have to wait for the candle to close. The fact that it dropped down, popped up, and came back is telling me there's too much volatility there for me to continue to manage my risk, and so I'd probably get out of the position. So the entry here, first candle to make a new high right down there. Now let's look at another example. So here you've got more of that classic stock starts squeezing up very quickly, maybe on breaking news that came out kind of right here around 8 a.m., top of the hour. All of a sudden it pops up to about $4.60. It pulls back, red candle, another little candle here. This is not a doji. We actually call that candle a spinning top. It has a small body and a little bit of an upper candle wick and a little bit of a lower candle wick. It's also a candle of indecision. In fact, anytime we see these dojis, they're candles of indecision. It's very common that the doji marks the top and then the bottom. So right there, boom, my entry, first candle to make a new high, which is this green candle here. So the entry, as soon as this green candle broke the high of the spinning top. What's my max loss? The low of the pullback. What's my profit target? A new high of day. And here we got to squeeze through the high. I don't have to sell just because it hit my profit target. I don't want to sell until I actually get an exit indicator. So here we get a squeeze all the way up to 5, to 515, 520, 530, and then it grinds a little bit higher. Notice these topping tail candles. So these are telling us that the price squeezes up and then pulls back, pushes higher, pulls back, pushes higher, pulls back, pushes higher, pulls back, and then we've got a doji, candle of indecision. Time to get out before the red candle forms. There's no reason to wait for the red candle to form or even for it to close. Once you get that larger doji, it's time to get out. All right, let's look at another example. So now we've got a stock that's been moving pretty nicely during the day. It's around 450, and then all of a sudden it kind of starts to move higher. 470, pulls back. 490, drops down. And this right here becomes the first pullback after this has begun to break out. As it begins to break out, you'll notice volume increases. So volume's picking up, and then you've got a little pullback right here, and now we've got a small hammer. You see that hammer candle? So this is what I think is so incredible. Now that you know what the hammer candle looks like, and you know the sentiment communicated by the hammer candle, as you're seeing it, and you're looking for that bull flag formation, you realize, wait a second, we're getting that candle that's a hammer. It's hammering out the base. I have to pay extra close attention. Now you get that green candle. The second the green candle breaks over the high of that hammer, that's your entry right there, 486. And this goes all the way up here to 570. It's a beautiful move. That's exactly what we like to see. So now I'm going to teach you the ABCD pattern. Now, the ABCD pattern has candle over candle inside it, and it also has a bull flag inside it. So it's really sequentially building with these building blocks that you're learning, each individual candlestick, and then these candlestick patterns to create the ABCD pattern. So let's jump onto the screen share and let me show you what this looks like. Typically, an ABCD pattern is going to be comprised of 7 to 9 candles. You've got that first rally up. So this is essentially a bull flag. It pulls back, and you know what? I might go ahead and take that trade. Boom, it goes up. But here's the thing where an ABCD pattern diverts from a bull flag. Instead of squeezing through a new high of day, which is of course what we would like, it stalls out. And this is where some people say, oh, it's a failed bull flag, that's it. And so the way I trade, I get in right here, first candle to make a new high, the bull flag, it goes up, and when it stalls out, when all of a sudden there's a big seller up here and it's not able to break, I don't just hold until it comes back down to break even or it turns into a loser. I take my profit. Now, this is a specific strategy that I implement in my trading. If I am in a trade and it goes up and I'm in a winning position, I do not let that turn into a loser. At the worst, I'll stop out break even. But typically, I end up seeing an exit indicator before it comes to break even. That can be in the form of a large seller on the level 2, or it could be just in the form of a burst of selling that goes through the time and sales where the stock doesn't go where I thought it would go. Because the moment I get in, what are the things I need to see? In order to see the stock go higher, we need to see buying. We need to see green on the level 2. We need to see green on the tape. We need to see a big green volume bar. So the absence of that buying volume by itself, for me, can indicate, nah, I better just step off of this. So I can get out with a small winner. Now it pulls back again. So let's watch this play out. So it pops up and then it pulls back. It dips down a little bit more. Now, this is what's most important during an ABCD pattern. It cannot break the low of this green candle. It's okay that it pulls back, pops up, and dips down, but if it breaks the low right there, then really what we're doing is we're just in a downtrend where we're stair-stepping lower. So yes, if a bull flag fails and it starts stair-stepping down, then the pattern is broken. But if it doesn't break that lower level, then at that point, I'm looking for the first candle to make a new high right here. And here's what I do a little differently. Rather than buying the first candle to make a new high right here as though it's the second bull flag, I don't typically do that because the problem was we previously had resistance right here. So what I actually do is I use that level as the price that needs to break. So when that level breaks right there, that's where I jump in. Now, sometimes as this starts squeezing up, you'll see such a burst of buying volume as suddenly short sellers begin covering, realizing that the bulls are still in charge, that this has just been consolidating and getting ready for that next leg up. So if I start to see a lot of buying right there, I may take a starter, but I don't add full size until it breaks the high of that price right there. So this is the apex of this pattern. I want to see that break, and then I still set my stop at the low of this latest dip. So generally with this, the distance from the entry to the stop is a little bit larger, but the good news is when these ABCD patterns work, you get even more buying volume. So here's something that's really fascinating. This right here, let's just say is this is a 1 minute chart. So if this is a 1 minute chart, we've got 2, 4, 6, 8 green candles, or eight candles in total. So now on the 5 minute chart, what's often happening is you have a green candle that's formed, you have a red candle dipping down, and then boom, you're getting ready for that first candle to make a new high, which would be right around the 10th and 11th candle. So then you're actually getting, in a sense, a mini bull flag on the 5 minute time frame. So you actually have multi-time frame alignment where both the 5 minute and the 1 minute are giving us the same signal, and it's a buy signal. So this is the ABCD pattern, which is a very powerful setup. So now here we go. This is a stock where we got that initial pop up, it pulls back, first candle makes a new high right here, we push higher, and then we dip down. Now remember, we don't break the low right here. We hold this level, we hold the base, and as we break this high right here, that's where I press the buy button right there. And in this case, we squeeze all the way up to here. Not a bad breakout. Here's another example. So right here, we get this nice rally up. We get a little pullback right in here. Oops, let me back up. We get this nice rally up. We get a little pullback right here. It pops up for a second. It dips down, and then it goes on the next attempt. And it squeezes from $3.25 up to over $4 a share, which is an awesome move. Now here's the next one. You get that big single candle pop, which is most likely the result of breaking news. So all of a sudden you had breaking news and the stock squeezes up pretty much in an instant on this big green candle. It pulls back, and you could certainly take the first candle to make a new high right down here. That's fine, but it doesn't go all the way through a new high. It pulls back one more time. And then in this case, this actually looks right in here, almost like a bull flag. And that probably would have been okay to take that entry right there and then add for the break through the high. And then you get that squeeze. So this is to me just what's so amazing about trading is that once you learn the building blocks, you see how they can be assembled sort of in different ways and on different time frames, the 10-second, the 1 minute, the 5 minute, and where you can trade the same stock multiple times. You could trade the first pullback, then the candle over candle, then the ABCD pattern. So it's like you get multiple opportunities to keep trading. Now I've tied all of this together in a trading plan worksheet that you guys can download. The link is pinned to the top comments, and it's also linked in the top of the description. In the trading plan worksheet, I document everything that we've discussed today, but I expand on it by adding in criteria for the type of stocks that I like to trade, my 5 criteria, to help me decide whether or not a stock is even worthy of considering in the first place. Because here's a tip. If you try to apply the patterns that I just shared with you on the wrong stocks, you'll get inconsistent results. What is the right type of stock to trade? It's not just stocks, it could be Forex, futures, cryptocurrency. The right thing to trade each day for me is an instrument that has high relative volume, that has above average volume for what it usually has. And that's typically because there's some type of breaking news catalyst. So the psychology going on here is that when there's a lot of eyes on it, all those buys, all the clear buy signals, a lot of people are seeing them. And then there's going to be a lot more buying at those logical points. And you're going to see bigger resolution of these patterns. If you tried to apply this to a security that has zero volume, then the candlesticks, what are they formed by? Maybe a couple algorithms that were buying and selling just sort of by chance, out of random. They're not going to work. So you got to make sure that you're trading the right stuff in the first place. That's one of the best things you can do for mitigating risk. But this trading plan worksheet you can download, you can begin utilizing it in your own trading. And it's gonna, again, document what we've covered today, but also expand with risk management and stock selection. So make sure you guys check that out. Now, I wanna give you another pop quiz here and kind of see how much you have learned. So as you look at this chart pattern, what do we see happening? We see the nice long body green candles right here, which is great. Red candle, and then what do we have right there? Our little dragonfly doji. So that's indicating the reversal has already started. And if the next candle makes a new high, what do we want to do? Press the buy button. And that's exactly, that would have been the right move. This gave us a really nice resolution. Here's another one. So now you've got a stock that's been squeezing up, but it hasn't given you a pullback yet. Finally, at the top, you get a little doji candle, little bottoming tail, little topping tail, a red candle. And now look at this, you've got a hammer. So it's hammering out the base, right? So the low of that candle is your stop. Your entry is right here. First candle to make a new high. Profit targets a break through the high a day. And do we get it? We do. And we get a squeeze all the way here up to $4.60, $4.90, up through $5. So how do we find the right stocks and the right chart patterns in real time? All right, my top 3 patterns work best on these types of stocks. Stocks at number 1 are already up at least 10% on the day. Number 2 have 5 times relative volume. Number 3 have a news catalyst. In fact, it is the news catalyst that pushes the stock up 10% on 5 times relative volume. So it needs to have the news. And number 4, most day traders prefer stocks between 2 and 20. They're less expensive. And most day traders have relatively small accounts. I mean, we don't have, multi-million-dollar accounts. So even on the spectrum of, okay, maybe you've got $25,000, $30,000 account, still it's relatively small. So most day traders prefer lower price stocks. So those are our 4 criteria that create demand. Being up 10%, having 5 times relative volume, having a news event, and being between 2 and 20. And now, number 5, the stock should have a float, or the number of shares available to trade, of less than 10 million shares. That represents the level of supply. The lower the supply, the greater the imbalance can be between supply and demand, because ultimately it is the imbalance between supply and demand that creates a big move. So let me give you a little example that I think will help demonstrate the imbalance between supply on the left and demand on the right. So let's imagine, for instance, we have a company with a float. Remember, float represents the supply. So we have a company with a float of, we'll do a couple different versions. We'll do 1 million shares, we'll do 10 million shares, and we'll do 100 million shares. Okay, so these are wildly different floats, but none of them are uncommon for us to see in the market. Now, what reflects demand would be the volume. So let's just say, for instance, we have a stock that has a 1 million share float, has 10 million shares of volume, and the rate of change, so this is the result of the imbalance, is that, let's just say the stock is up 100%. Okay, so the stock's up 100% with 1 million share float and 10 million shares of volume. So what I find interesting here is that if you have a 1 million share float and the company is up 40% or 50%, you've got 1 million potential shares that are up 40, 50%, and presumably some of them are going to want to sell, right? If overnight, all of a sudden you're up 50% on a position, what are you going to do? You're probably going to sell. So if you've got 10 million shares of volume, then you've got more than enough volume, more than enough demand to absorb all of the selling that is inevitable when a stock is up quite a bit. So if the stock continued to go all the way up to 100% on this amount of volume, what that tells us is that the underlying catalyst, or the news, is really strong. It's so strong that not only have all of the people that were holding had the opportunity to sell, but people are just continuing to buy and buy and buy. They're really excited about that stock. But let's play this out a different way. So let's say we've got the float of 10 million shares and we have the same 10 million shares of volume. So now this changes things drastically because all of a sudden the stock pops up, but you've got 10 million shares that are going to want to take profit. And so in this scenario, it wouldn't surprise me if instead of seeing the 100% move, we saw only a 10% move. That wouldn't surprise me one bit. And now let's take it a step further. You've got stock with a 100 million share float, but it has only 10 million shares of volume. As soon as that stock is up a little bit, you've got so many insiders that are, or not insiders, but so many existing shareholders that are going to want to sell. Man, this thing might not even go up 1%. As soon as it starts to pop up even a little bit, there's people that are going to start selling. And so the result is that the greater the level of supply, ultimately, the more demand you need in order to get the same percentage move. So if we were hoping, let's say that this 10 million share float company would go up 100%, well, you're probably going to need more like 100 million shares of volume, right? For the 100% move. And here, yeah, you're going to need more like 1 billion shares of volume. Is it impossible? No. Is it likely? Yeah, not really. It's not that likely that we would see that. So what we know is that the stocks that I tend to make the most money on will have this extreme relationship between very high demand and generally a limited level of supply. Now, some people would say, Ross, where do you even come up with these numbers? Up 10% on the day, 5 times higher volume than average. What is that all based on? So I'm actually going to show you my metrics right here. These are metrics from my own trading. This is real money. And what you're going to see here are the report of over 30,000 trades that I've taken, showing and verifying here $15.4 million in trading profits. $15.4 million. All right, now I'll be the first to tell you my results are not typical. I have been doing this for a very long time. But nonetheless, this is all of these metrics are really helpful because these help paint the picture of why I'm telling you these back here are the 5 criteria that we need to focus on. So let's just start with price. So if we look at price, you'll see here that I make the most money on stocks that are between $2 and $20 a share. That is my sweet spot. So when I tell you that 2 and 20 is the place to focus, it's not just pulling it out of thin air. It's actually based on my own metrics. When I tell you that I do best on stocks that are up more than 10%, when we pull this up, I'll scroll down, you'll see right here, performance by instrument movement, right there, 10%. So I need to be trading stocks that have the potential to go up 10%. And as you can see, if they do, that's where I make a lot of money. Now, right up here, you'll see performance. This is it. Performance by instrument relative volume. So almost all of my profit is when the stock has 500 times or 5 times higher volume than the 50-day average. So what that means essentially is, and we could just I'll pull up a random chart here. Let's see. Let's look at a stock that was in play. We could even look at this one here that we were just looking at a little bit ago. So this stock is now up an astonishing 560%. This is PSTV. It's got news today. It's got 346 million shares of volume, 5.76 million share float. Now, how much volume did it have today? 346 million. How many shares did it trade yesterday? 1 million. So today it traded 346 times higher volume than just yesterday. And it actually traded 600 times higher volume than its 50-day average. Why would a stock trade 600 times higher volume than its 50-day average? Well, they've got a headline right here. Granted, US FDA orphan drug designation. So they've got a catalyst, and that catalyst is that's what brought in the volume initially. That's what created that rate of change. And because the stock was more affordable, people were much more likely to jump on it. So that's a perfect example of a stock that met all 5 criteria of stock selection. So my routine each morning is I sit down and I look for the leading percentage gainers in the market. So on this particular day, just as an example, the leading percentage gainer in the market was ATNF, and it was up 564%. It actually had a 1 million share float, 930,000, and it had 58 million shares of volume. The volume was 3,604 times higher than average. So this met all, and it had breaking news. So this met all 5 criteria of being worth trading for me. And of course, I traded it. So my first step was to find the stock on my scanners. Now, I have scanners that I utilize in my own trading. And of course, if you wanted to check them out at Warrior Trading, you'd be welcome to. It's software that I began developing in 2017. But if you use scanners even just on your trading app that will show you the leading percentage gainers each day, then that would be a good start. You would want to make sure you could check the float and the relative volume just to make sure those check out. But as long as you could see the percentage change, you could find that other stuff fairly easily. And you have to check the news as well. So step 1 is finding the stock moving. Step 2 is making sure it meets all 5 criteria of stock selection, which we just covered, and checking the news. What is the catalyst? Why is this moving higher? And then once I see the catalyst, it's time to wait for the pattern to form. So now I'm waiting for the bull flag. I'm waiting for the candle over candle pattern. I'm waiting for the ABCD pattern. And when I see it, I execute. And this right here is $98,754.39 in one day. And so here's the thing that's really important. And really, I mean, again, it's incredible. Once you learn these patterns, you're going to see the buy and sell signals right there on the chart. So really, it's just a matter of, are you trading something that's moving? Because if you're buying and selling forward and it's not moving, you're not going to make money. But if you find something like ATNF on that day where it went up over 500% on news, that's the type of stock that when you see these patterns, you want to pay a lot of attention to. Now, I promised you guys some recommended reading. So the first book here is Thinking in Bets by Annie Duke. This is an awesome book written by Annie Duke. She's a professional poker player. It's about making smarter decisions when you don't have all the facts. That is trading, right? We don't have all the information. We essentially are doing the best we can to predict and see into the future. And the traders who do it the best will make the most money, but you can develop your edge not just through technical analysis and reading candlestick charts, but also through mindset, through knowing how to cut your losses and walk away before it's too late. Now, a second book on that note is The Power of Knowing When to Walk Away, Quit. This is fantastic. I've gotten really good each day at walking away. Every day you're doing one of 2 things. You're leaving money on the table or you're giving back profit. And I'd rather leave a little money on the table, but walk away with profit in my pocket. It's a really important skill to learn. Now, if you like Thinking in Bets by Annie Duke and you like Quit, another book that you could check out is The Happiness Advantage right here. This is also all about mindset. And the fourth book, Trade Mindfully by Gary Dayton. Again, another book about mindset. Now, one thing that I can tell you when it comes to trading is that you never stop learning. Even today, I still learn new variations on patterns I haven't seen before, but they start working. I recognize, all right, when that happens, this follows. That's an opportunity for me to extract a little more profit from the market. So here's what I would lay out as the next steps for you. When it comes to reading candlestick charts, we've broken down my 3 most profitable candlestick chart patterns, but we haven't talked a lot about technical indicators. The technical indicators, and one of them that I have right here at the bottom of this panel, is an indicator that I use pretty much all the time in my trading. It's called the MACD, Moving Average Convergence Divergence Indicator. And this gives very clear green light, red light, buy and sell signals when you use the MACD on the right stocks. So I'm going to put a link to an episode that's going to teach you how to use these technical indicators, and I'll put that up here. What I'm also going to do is I'm going to put the link to the deep dive of decoding those individual candlestick shapes for those of you guys that want to become a real expert at understanding every candlestick shape out there. That'll be right there. And don't forget to download my trading plan worksheet, which you can utilize in your own trading starting today. If you enjoyed this episode, I hope you hit that subscribe button. I hope you hit the thumbs up. And let me remind you, as always, trading is risky. My results aren't typical. So always practice trading in a simulator before putting real money on the line.